Ever wondered how Johnson and Johnson compares to Pfizer in terms of stock performance? Well, you're in the right place. Today we're going to delve into a head-to-head analysis of these two healthcare and pharmaceutical giants. We'll be looking at their financial performance, focusing on key metrics such as total revenues, profit margins, and net profits. We will also explore their stock performance, financial health, efficiency, and return on equity. So buckle up and get ready for some number crunching. Let's dive into the numbers. To begin, let's look at the total revenues for both companies. Johnson & Johnson and Pfizer, two of the leading healthcare and pharmaceutical conglomerates in the United States, have had contrasting revenue trajectories in the last 3 quarters of 2023. Johnson & Johnson reported $64 billion in total revenues, while Pfizer reported $44 billion. Since 2018, Johnson & Johnson's revenue has been fairly stable, while Pfizer has experienced a significant growth phase during the COVID-19 pandemic from 2021 to 2022. In fact, in 2022, Pfizer's revenue surpassed that of Johnson & Johnson, with a total of $76 billion compared to Johnson & Johnson's $60 billion. The revenue structure of Johnson & Johnson is composed of 64% from innovative medicine and 36% from MEDTECH. On the other hand, Pfizer's revenue is almost entirely reliant on Biopharma, accounting for 98%, with the remaining 2% coming from other sources. In terms of geographical distribution, Johnson & Johnson generates 54% of its revenue from the United States and 46% internationally. Pfizer's revenue is 51% from the US, 16% from developed Europe, 11% from developed rest of world, and 22% from emerging markets. So, in terms of total revenues, Johnson & Johnson has been fairly stable, while Pfizer has seen some growth, particularly during the COVID-19 pandemic. Now let's compare their profit margins. In the last 3 quarters of 2023, Johnson & Johnson boasted a gross profit margin of 69%, a slight increase from their 5-year average of 68%. On the other hand, Pfizer's gross profit margin sat at 61%, a noticeable drop from their 5-year average of 72%. Furthermore, the net profit margins of both companies showed contrasting trends. Johnson & Johnson's net profit margin was a whopping 49%, almost double their 5-year average of 26%. This significant increase is attributed to the company's ability to maintain stable operational costs while increasing their revenue. Contrastingly, Pfizer's net profit margin was a meager 12% in the last 3 quarters of 2023, down from their 5-year average of 30%. This significant decrease can be largely attributed to a decline in revenue. While Pfizer's sales costs, management expenses, research and development costs, and amortization of intangible assets remained relatively unchanged, their revenue took a hit, thereby affecting their net profit margin adversely. In terms of net profits, Johnson & Johnson generated a net profit of $31.1 billion, while Pfizer managed a net profit of $5.5 billion in the last 3 quarters of 2023. Comparing this with the same period in 2018, Johnson & Johnson's net profit grew at a compound annual growth rate of 20%, while Pfizer's net profit shrank at a compound annual growth rate of -14%. What does this mean? Well, despite Pfizer's revenue growth, their profitability has been hampered by stagnant costs and declining revenue. On the other hand, Johnson & Johnson, with their superior profit margins and impressive net profits, has demonstrated a stronger ability to convert their revenue into profits. In terms of profitability, Johnson & Johnson outperforms Pfizer despite the latter's revenue growth. How have the stocks of these companies performed? Well, let's take a walk down memory lane to 2018. Imagine you had a spare $1,000 to invest. You decide to put that money into either Johnson & Johnson or Pfizer. Fast forward to February 2024, what do you think your investment would look like? If you had put your money into Johnson & Johnson, your initial $1,000 would have grown to $1,214. That's an increase of 21% over the initial investment and an annual growth rate of around 4%. Not bad, right? But what if you had decided to go with Pfizer instead? Well, it's a different story. Your investment would have dwindled to $650. That's a decrease of 35% from your initial investment over 5 years. Quite a contrast, isn't it? Now you might be wondering why the stark difference. Why did Johnson & Johnson provide a better return while Pfizer's stock value decreased? The answer lies in their business performance during this period. Pfizer, despite being a major player in the pharmaceutical industry, saw a decrease in its business performance. The company's net profit margin took a hit, dropping significantly in the third quarter of 2024 due to a decline in revenue, while their operating costs remained unchanged. This decline in business performance is mirrored in their stock market value, explaining the drop in the value of your hypothetical investment. On the other hand, Johnson & Johnson managed to maintain a steady growth trajectory. Their innovative medicine and medtech sectors contributed significantly to their revenue, ensuring a stable profit margin and a healthier return on investment for their shareholders. In the grand scheme of things, it's clear that investing in a company goes beyond just looking at the name or the industry it operates in. It's about understanding the company's financial health, their profit margins, and how they manage their resources. Clearly, Johnson & Johnson has provided a better return for investors over the past 5 years. Let's now examine the financial health of both companies. As we transition into the third quarter of 2023, we see a fascinating divergence in their financial statuses. Johnson & Johnson's total assets stood at a formidable $166 billion, while Pfizer's total assets towered at $215 billion. When we delve into net assets, Johnson & Johnson held $71 billion, and Pfizer was not far behind with $97 billion. But it's not just about the assets, it's also about how these companies utilize them. When we look at the equity to total assets ratio, Johnson & Johnson stood at 43%, while Pfizer was slightly ahead with 45%. This suggests that Pfizer is slightly more efficient at generating profits from its assets. Now let's turn our attention to liquidity, which is a measure of a company's ability to cover short-term obligations. The current ratio for Johnson & Johnson was 1.21, while Pfizer boasted a significantly higher ratio of 2.38. Similarly, the quick ratio, which is a stricter measure of liquidity, was 0.96 for Johnson & Johnson and a robust 2.05 for Pfizer. These ratios suggest that Pfizer is better positioned to handle sudden financial downturns or unexpected expenses. It's like having a more comfortable safety buffer or a larger rainy day fund. So what's the takeaway from all these figures and percentages? While Johnson & Johnson may have had higher revenues and net profits, Pfizer demonstrated stronger financial ratios. It showed a better ability to generate profit from its assets and had a stronger liquidity position. This could suggest that Pfizer might be more resilient in the face of financial turmoil or market fluctuations. Despite its lower profitability, Pfizer appears to be in a stronger financial position. It's a fascinating contrast, isn't it? But remember, financial health is just one aspect of the overall picture. We'll delve into operational efficiency and return on equity in our next scene. Finally, let's look at the operational efficiency and return on equity of these companies. The inventory days for Johnson & Johnson and Pfizer are quite similar, standing at 147 days and 149 days respectively. This indicates the average number of days that both companies hold their inventory before selling it. When it comes to receivable days, Johnson & Johnson takes about 61 days to collect revenue after a sale has been made, while Pfizer takes a bit longer at 67 days. The shorter the receivable days, the faster the company is able to collect its account receivables, which is a positive sign for operational efficiency. Let's now examine the cash flows. Johnson & Johnson's operating cash flow is at $14.9 billion, significantly higher than Pfizer's operating cash flow of $3.5 billion. This indicates that Johnson & Johnson is generating more cash from its core business operations. Moreover, Johnson & Johnson's free cash flow, which represents the cash a company is able to generate after laying out the money required to maintain or expand its asset base, is at $11.9 billion. This is a stark contrast to Pfizer's free cash flow of just $500 million. Over the years, both companies have experienced a decline in cash flows, with Pfizer experiencing a sharper decrease. Now let's talk about return on equity, a measure of financial performance calculated by dividing net income by shareholders' equity. Johnson & Johnson has a return on equity of 58%, significantly higher than Pfizer's 8%. This means that Johnson & Johnson is more efficient at generating income on the investment received from its shareholders. In conclusion, when we consider operational efficiency and return on equity, Johnson & Johnson again outperforms Pfizer. It's crucial to remember that these metrics are just part of the bigger picture, and investors should always consider multiple factors before making investment decisions. So what's the verdict? After a thorough assessment, it's clear that Johnson & Johnson has consistently outperformed Pfizer in terms of profitability and operational efficiency. Pfizer, despite a stronger financial position, hasn't been able to capitalize as effectively. In the world of investing, understanding a company's performance isn't just about the numbers, but also about how these numbers are achieved. Remember to subscribe to our channel for the latest videos, and let us know in the comments which company you would like us to analyze next.